Welcome to The Bottom Line with John Harrison, your tour guide through all things financial. Build out your financial skill set with crucial knowledge and tactics and easy to follow answers to all your essential money questions. And now, your host, certified financial planner, ordained minister, multi-published author, and president of Aspire Financial Advisors, John Harrison.
Hello, and welcome to The Bottom Line. I'm John F. Harrison, your host. And in this episode, we're going to be rounding up some financial news because you kind of have to look for financial news. The mainstream media doesn't always carry much in the way of what's going on with the economy and your finances. If you look at the typical 30-minute news broadcast, at least 10 minutes of that is sports and 10 minutes of that is weather, and there's a few minutes of what celebrities are doing, and there really isn't a lot of time devoted, once they get past the latest tragedies, to things going on in the business world that will affect your personal finances in various ways. So in this episode, we want to take a look at that, and there really is some breaking news that we'll get to. There's actually an important report that's coming out on the day of this taping, and I'll touch on that. But we want to talk about some things as well that have recently come out, and these are things you're not only going to want to know about the facts, but how they affect you. So grab a pencil and something to write on and get comfortable, and when we come back from this small bit of business, we're going to jump right into the news of the day. That's next.
People say I've got a great smile. Well, I have to say, this is all thanks to the professional team at Beacon Dental Group right here in Dorchester, Massachusetts. I've got world-class dental care. Beacon Dental Group has expert and caring staff dedicated to providing the most advanced and satisfactory treatment in all aspects of oral health. Their services are designed to meet your needs and give you a perfect smile, too. General checkups, cosmetic surgery, Gemini laser service, and advanced procedures, all in a state-of-the-art facility. Call or visit Beacon Dental Group today, 1026 Blue Hill Avenue, Dorchester, Massachusetts, or call 617-282-2146 for a smile that lights the world.
Welcome back to The Bottom Line, and we're talking about the financial news of the day, some of the reports that are coming out now and have come out recently. And I want to start with the March jobs report. Employers across the country added 236,000 new jobs for the month of March. That's historically a pretty good gain, smallest in the last 2 years. And most of the news reports that you hear will focus on the fact that that's either still doing pretty well or that it's not doing as well as it used to be, smallest in the last 2 years. But here's the piece that normally gets missed. A jobs report that strong is still inflationary. And this brings us to why they pay the Fed governors the big money, because they are caught between a rock and a hard place. They are trying to manage the economy in such a way that inflation doesn't get out of control. And they also don't want to provoke a bad recession. And so they're trying to chart the middle course and balance on a beam to keep things running without disaster happening either way, to one side or the other. Now, $236,000 new jobs is a slower pace, a cooler pace than what has been of late. It suggests maybe things are cooling down, and that's what the Fed wants. But it's not cooling down big enough, fast enough for their taste. The average hourly earnings still rose 4.2% last month. That's very inflationary. And so that will provoke at least the more hawkish of the Fed governors to maybe be more aggressive about raising rates. So that's not necessarily a good thing, because they're raising rates in order to slow the economy. If they overdo it, they will slow it too much. We have a big recession on our hands. So the report shows that things are cooling. The question is, are they cooling fast enough to suit the Fed? Because if they fear that inflation is not under control, they will raise rates even further, and that's not a good thing for the economy. The problem they're having is that even with the slower pace of new jobs added, unemployment is still quite low. We're around 3%. The Fed wouldn't mind having it at 5%. Some states are lower still. Wisconsin, the jobless rate is 2.5%. So there's not a lot of unemployed people. The Fed wouldn't mind seeing unemployment rise because it takes the pressure off wages and it slows consumer spending, which is what they want in order to tackle inflation. So that's something to keep an eye on if there had been a real decline. And interestingly, the numbers I gave you were national numbers. Some regions, there were actually net job losses. The Southeast, the Central South, Bible Belt South, and even as far west as Texas actually had job losses on a net basis in March. But nationwide, buoyed by strength in other parts of the country, we still gained that 236,000 new jobs, and it will be interesting to see what the Fed does with that information. Their next opportunity for a rate hike is in May, so that's coming up. And the markets, of course, will try to anticipate what they're going to do by analyzing all the reports like this that come out. They're going to try to predict what the Fed is doing. So there are inflationary pressures like this not so bad job report, but there are also deflationary or recessionary pressures on the economy. A report in the Wall Street Journal says that bank volatility will cut U.S. economic growth. That's according to the IMF, the International Monetary Fund. It says U.S. banks' lending capacity will decline by 1% this year due to the fall in value of many bank stocks as investors reassess the health of mid-sized banks. That reduction in lending is expected to shave 0.44% off the U.S. gross domestic product in 2023. Now you may say 0.44%, less than 0.5%. Is that really a big deal? Well, when you can figure that in 2022, GDP, gross domestic product, for the United States was $26.13 trillion. A trillion is 1,000 billion. So the GDP was 26.13 trillion last year. If we lost 0.5% of that, it's actually a rather large number of dollars. So when the numbers get this huge, even 0.5% is a real difference in dollar terms and something to keep an eye on. Regional and mid-sized banks are very important to our economy because they account for 1/3 of all bank lending. Normally when we hear about banks, we hear about the big internationals, the former Credit Suisse, UBS, Barclays, or we hear about the largest American banks, the Bank of America, Chase, Citi, some of those banks. But it's your local, regional, and mid-sized banks that do 1/3 of the lending in the economy. And so if they start being tighter with money, then it's going to affect a lot of people. Something to keep an eye on as you are paying off your debts. I consistently advise people to, especially in times where there can be slowdowns and recessions, to stockpile cash and reduce debt. If you have outstanding debt on credit cards, if you have car loans, if you have personal loans, get rid of those things, give yourself some margin, free up the cash that will be available to invest when things turn around, or ideally just before things turn around. And the one caution that I would give you is with lines of credit. You've got an unsecured line of credit at your bank. You've got overdraft protection on your bank account. You have credit lines on your credit cards. When things get tight with banks, they may withdraw some credit that you don't use because your available credit is a liability to the bank. Only your outstanding credit is a liability to you, and that's an asset to the bank. So they like your outstanding credit, but when things get tight for them, they like to cut your available credit. So do be aware of that possibility. It can negatively impact your credit score. If you've got a $20,000 credit card and you manage it well, and so you're never using more than, let's say, $6,000, $6,500 of that credit line, you may find that some of the credit line disappeared if the bank is tightening up, and that increases your utilization rate, and that actually can lower your credit score. So it can hurt you even if you haven't done anything. So every once in a while, it might hurt to use the card like cash, put a fairly good sized chunk of something on it, and then pay that off right away. And if they see you're using it, they may be a little less likely to withdraw or shrink the available credit line. But banks in general are going to be tighter with a dollar than they have been. That makes it harder for businesses to get business loans that they often need. It is a general slowing down of the economy. So that is something to watch for. This all started when you had those high-profile big bank collapses, and it just sort of added to the general fear and uncertainty that's going on in the banking industry. So that is something we expect to be a bit of a drag on the economy. That's recessionary, that's deflationary, and that's the balancing game that the Fed is playing. They're looking at this report over here, like the jobs report, this may be a little inflationary, versus what's happening in the banking world. They don't want to upset that too much. That's recessionary, and they're trying to make a judgment call. Wouldn't want to be in their shoes. There is another area that is adding recessionary pressure to the economy, and that's an aspect of commercial real estate that we haven't talked about. You may remember last episode we talked about office buildings. The downtown core of all of our cities are office buildings, and we talked about how office buildings are feeling the pressure of post-pandemic workers not returning to the office, lots of office space being empty, the buildings starting to have cash flow problems. One of the areas that we have not talked about is rental real estate. And I saw an interesting article also in the Wall Street Journal that said Houston apartment owner loses 3,200 units to foreclosure as multifamily feels the heat. And the upshot of it was that Apple's Way Investment Group, a real estate concern out of Texas, borrowed nearly $230 million to buy buildings with more than 3,200 units as part of a buying spree during the pandemic. Arbor Realty Trust, a publicly traded mortgage company, foreclosed on the properties after Apple's Way defaulted on the loans. Now you may wonder, how does a big company like that default on its loans? Well, as you know, the Fed has been raising rates, and that means adjustable rate mortgages have been going up. And when the adjustable rate mortgages go up and the monthly payment increases, but the rental increase is not as fast, then you may find landlords can't pay their mortgage payment. That's what happened here. I'll tell you a bit more about that and how much of a problem this is likely to be, or things like it, when we come back from this short break. See you in a minute.
Do you want to make a bold statement? Do you want to stand out in the room? Check in with us before you step out. On-demand designs and timeless statement pieces are here to channel your impeccable style from this season to the next. You can have it all, so go get it and be confident when you do. Jewels on Demand, inspiring elegance and confidence.
Welcome back, and we're still talking about some woes in the real estate industry that have maybe been flying under the radar. There has been talk of what's going on with commercial office towers, and most real estate talk is always about the price of single-family homes. But this issue with multifamily and landlords, particularly large commercial landlords, having problems making the mortgage payments on their rental properties, because as a general rule, most of these are financed with adjustable rate mortgages. And these commercial mortgages are usually short term, say 5 years, and they reset and you have to re-up the mortgage to continue. So how is that affecting these people? Well, the one in Houston that I mentioned, this Apple's Way firm, did a fairly highly leveraged deal. They put 20% down and financed the other 80%. That's typical for a consumer buying a home. That's actually a lot of leverage in the commercial space. And they purchased this property with an adjustable rate mortgage. Rates were up about 3.4% when they bought. Well, the rate on this particular property has risen to 8% now. So you can see what that has done to their mortgage payments on this $230 million loan. So they were unable to keep up with the mortgage, and the bank foreclosed on their mortgage. And other large firms are having similar issues with floating rate multi-property debt in recent months. The article cites Veritas, a company in San Francisco that defaulted on a $450 million loan backed by rent-controlled apartment buildings. So they couldn't just raise rents to keep up with how things were going. Blackstone Group is negotiating with its lender over the debt on a portfolio of New York City apartment buildings. And the big issue here is that this could accelerate and become more common as loans come due and the hedging contracts that they use to protect landlords from rising interest rates start to expire. A record $151 billion in U.S. mortgages backed by rental apartment buildings are set to expire this year, and $940 billion worth are expected to expire over the next 5 years. So this could be, the pebble that's starting down the mountainside, and it snowballs and maybe creates an avalanche. So again, these stories don't always make the news, but these are things that if you want to understand what's happening in markets in the short term, these kind of things will tell you what and why. I'll tell you one other thing about the short term, and then we'll put this all in perspective and tell you why long-term thinking is still the way to go for any long-term planning you need to do. Here's a short-term surprise. Bitcoin leads crypto rally, climbing above $30,000 for the first time since last June. I bet you didn't expect that one. Cryptos, as we know, collapsed last year as the Fed began its aggressive interest rate hiking. And no one knew what to make of crypto. In the early days of the market, it was assumed that crypto would be a hedge against inflation, the way gold traditionally was. It was assumed that it wouldn't be very closely linked with the stock market. It turned out that it was fairly strongly correlated with the stock market. When stocks went down, often so did crypto. And it hasn't been a hedge against inflation. What's been happening has sort of decimated crypto as of last year. And Bitcoin in particular, which had reached a high of about $62,000 per coin, dropped tremendously and dropped down below $20,000 per coin. But it has been rising this year. It rose 4% to $30,264 per coin as of the most recent trading day. It's up substantially year to date, and it's very interesting. Crypto while I still don't view it as a real investment in the traditional sense, it's speculation. And I say that because there is no intrinsic value that you can point to. If you're in an investment with a company, like you're going to buy stock in Ford Motor Company, just to pick a name, there's an intrinsic value. You will conclude to yourself, well, the company is worth, some multiple of whatever it's going to earn this year. And even if it doesn't earn anything, even if it goes out of business, it's got buildings and factories and land and inventory and things that can be sold off for money. So there is an intrinsic value to a company like that. Bitcoin is a different thing. All cryptocurrencies are a different thing. There is no intrinsic value. There's the value that the next buyer puts on it. And so that makes it a bit more speculative than some other things, especially when the market, the number of people investing in it is small. Then it can have outsized moves either to the positive or to the negative. But it's a great illustration of how with all investments, most people invest exactly backwards. And by that I mean they buy high and sell low. What you want to do is buy low and sell high. But they do the opposite because most people are led by their emotions. When you first started hearing about crypto in the news, it's because of the great rally it was having. It's because how Bitcoin in particular, went from a fraction of a penny per coin when it was first introduced up to $62,000 per coin last year. You heard about crypto millionaires, somebody who started with $1,000 and let it run and became millionaires or multimillionaires in the process. So by the time that process had gone on long enough to make people really rich, and it was big pricing for the coin, big money for the investors, that's when most people became aware of it. And that's when most people started investing. So the odds are very good that, if you invested in crypto, the odds are very good you did it when Bitcoin was at 28 or 30 or 32 or 50 or 60, not when it was way back in the early days. And then, of course, it plummeted and everybody panicked last year and got out. Now it's up more than 80% so far year to date, and it's not attracting as much attention, but the same process will repeat itself. The people who are frightened and skeptical will wait to see how it does, and if the rally continues, it'll get high again. It'll recover and get back to where it was and then keep going. And at that point, people will say, okay, this is for real, I'm going to jump in. And then the next crash hits them and they jump out and they repeat the process of buying high and selling low, when what you need to do is do the exact opposite. So whether you're buying cryptocurrencies or you're buying real estate or you're buying stocks, the best time in the world to buy is at the point of maximum panic. When everybody else is convinced it's over. There's a famous headline from a national magazine. I believe the magazine is Business Week. We go back to 1973 for this, and the cover story, the cover of this 1973 Business Week magazine was called "The Death of Equities." And the supposition of the article was that stocks had been doing so poorly through 1973 and 1972 and even in the late 60s, stocks had been doing so poorly that people in the future wouldn't invest in stocks. There were other things that people would invest in, and that stock investing was dead. And of course, the coming out of that article just about lined up with the beginning of the next rallies that took us from where we were then on the Dow to where we are now. Back in the 70s, the Dow Jones Industrial Average was hovering around $1,000. Today, while we have our ups and downs, we're somewhere around 32,000 on the Dow. So it certainly wasn't the death of equities, but the gist of that headline, and I know that magazine would love to be able to take that one back because people have been quoting and laughing at that headline for 50 years. But it illustrates how people think, and it tells you that the best time to get into a market is when everybody else has panicked out. And when maximum panic is there, then you can scoop up shares or properties or whatever it is you're investing at. You can scoop them up at bargain prices and wait for the inevitable profit. And that's really the best way to invest in something. You can't time the market, but you can look at what other people are doing. And if everybody else is running for the exits, when they are convinced it's over and done and there's no hope, that's when you want to get in because the biggest rebound will be fast. We're going to take another break in just a minute, and I'm going to put this all in perspective with a little summation called Stocks for the Long Run, and we'll look at why that's true in just a minute. Stay tuned, don't want to miss this.
The Well Jamaican Restaurant, located at 55 Mazzio Drive in Randolph, Mass., where good food and fellowship meet daily. Check out our variety of fresh and tasty entrees and sides from our menu or the website, thewellja.com, like our jerk chicken, oxtails and rice, seafood, desserts, and more. With our drinks and juices made fresh daily, you have the option to dine in or take out. We can also cater your special event, or you can book our private dining room and let us host your special event. At the Well Jamaican Restaurant, we pride ourselves on providing superior quality food and beverages, and of course, great customer service. Next time you're in the mood for Jamaican cuisine, meet us at the Well Jamaican Restaurant. Become part of the family. Connect with us on Facebook and Instagram. The Well, where good food and fellowship meet daily.
So we've been talking about news of the day that affects the economy and affects the short-term movements of various investment markets. But I want to stress that short-term movements are not where your future lies. That's for the long term. And nothing the market does today is going to matter in 20 years. There's a company called Ibbotson that puts out a chart every year that shows you what would have happened if you had put $1 in various investments beginning in 1926 and held them for the time, through the whole time. This one ends in 2022. If you had put $1 in small stocks then, it'd be $49,452 now. Large stocks would be $11,535. The next closest category to stocks would be bonds, which would be a whopping $131. And so it gives you an idea that long run, the stock market treats you very well. Short term, it's a scary ride. Long term, it's a great one. If you need some help deciphering all of this and how to tell what's short versus what's long and should you be doing anything different, I'm happy to chat with you. Give us a call. You can always reach us by phone, 978-775-5435. No charge to talk to us on the phone to see if we can be of any help to you, maybe answer some questions. You can also email john.harrison@aspirefa.com. Love to get emails. Happy to answer your questions there as well. And you can find us on the web if you need to learn more about us at AspireFA. That's Aspire, F as in financial, A as in advisor.com. Hope to see you at one of those places, either email or phone or just checking out our website. And as always, I like to say, it's a complicated world, the world of finance, and sometimes you can lose your direction in all the information. But wherever you're trying to get, you can get there from here. You just need a little direction for the journey, and that's the bottom line.